So
Okay.
the private equity model is not that old as a baseline, right? So I think the first private equity deal here was done around 1982.
Okay.
And the innovation behind private equity is that, so let's start with some background context, right? So there's two prevailing business models here. You have the venture capital, and then you have the private equity. So they're very different in the sense that venture capital is talking about taking companies who are nascent, who are in many cases pre-revenue, definitely pre-profit, but they have an idea that they think could take over a market. It's almost
Okay.
always technology ventures. So it's going to be like, hey, I think this new AI thing, as an example, because AI is a new hot buzzword, is
Yeah.
gonna kind of completely transform this industry, and I want to get on the ground floor, so I'm going to fund it. I want to take a big equity slug for funding it, and I take outsized risk. So VC has to be very comfortable with taking risk, with being able to see what's not there. It's a very
Mm.
different operating model. Private equity is the complete opposite. Private equity is kind of the Warren Buffett of investing. You're saying, hey, you know what? I want proven revenue,
Yeah.
long-term proven profitability, but where I know I can come in and tap a couple of levers and get an outsized return. So with private equity, so it's effectively a model where it's like proven revenue and I can add debt to get an outsized return. So I'm
Yeah.
actually going to give a little bit of background here on the first private equity deal. It was a deal where they bought this Gibson Greetings. It was a greeting cards company. And
Mm.
what was so innovative about this acquisition, it was done in 1982. They bought the company for about $81 million, but they only put $1 million of their own equity in the deal. The other 80, they either borrowed it from multiple financiers or they sold assets of the firm to fund it. And so it was a private equity deal because they came in using private debt. They put very little of their own money in the deal, and within about 18 months, they sold it for 290 million. So they walked away with $66 million in profit. They only invested 1 million out of pocket. That's a 66x return. That is a private equity return. So they grew the company 2 or 3x, which is normal, but because they only put in a million, they got a 66x return on invested capital. And so that's really one of the when you're thinking about what's the private equity incentive, they're not looking to 10x the company, they're looking to 10x their investment. And because they're
Yeah.
putting so much debt in it, they have so much limited invested capital in the deal. That's how they're getting their returns, right? And so with that backdrop, it's really important to consider that, I mean, prior to now, for the last decade, right, we've been at almost 0% interest rates.
Right.
Liquidity has been highly available. And so
Yeah.
this has really driven up the private equity activity. They could get money very cheaply. Traditional markets have become quite expensive. And so they've kind of been transitioning into these other private markets as a way to establish deal flow. And historically, and I'm going to go back to your point, you're like, why the trades? Because historically, private equity was not active in the trades. So if we
Right.
look at the heuristics of stuff that private equity is interested in, it needs to be stuff with pretty limited operating risk. So the quintessential asset class here is going to be real estate, where it's like the asset generates the value. You don't have a bunch of people. You might need a property manager, but it's fairly commoditized. And
Sure.
that's why real estate multiples, especially during COVID, were very, very elevated. But yeah, so real estate pricing was getting extraordinarily expensive. I mean, in certain asset classes, if we're talking commercial asset classes, they were effectively paying 20 to 30x last year's profit for these things with no strategy to upsize. It effectively turned it into a bond. It's like, hey, you know what? Low risk asset. It's going to inflation adjust. I could put my money in and protect it. And so people start looking for other investment opportunities. And so they start going down the list of like, okay, what can I invest in where there's some degree of scalability, where it doesn't have service delivery risk, where it's recession resistant? And one of the areas you started to see a lot of activity, this is even prior to the trades, is actually in the medical industry. Like I have a friend who's a cardiologist. Almost all the cardiology groups, or many of the cardiology groups in Texas, Houston, are rolled up into a private equity group at this point. And because their
Really?
idea is very similar to what you see in the trades, it's like we could get a bunch of these together. We can better negotiate with the insurance company as a group, so we can effectively push up pricing. We can also, a lot of these guys have a lot of auxiliary services. They have to refer out clients. They can refer to
Sure.
each other, or
Sure.
they can partner with a hospital system and kind of get a percentage of those deal flows. So they started seeing like, hey, you know what? Yeah, there's a doctor here, but we'll keep the doctor on board. The doctor's not really a businessman in many cases, so we'll give him kind of an
Uh-huh.
operating arrangement and let this be a business. So, you know, they went through a lot of these verticals. And then during COVID, what really happened was that there was this perception, I use that word loosely here, right? That trades were suddenly recession resistant, right?
Sure.
Because even in the middle of COVID, you saw all this activity improvement. Said, hey, you know what? Like deal flow's down because most of these businesses are seeing economic restriction. Trade businesses, on the other hand, are going up. I got less deals on my desk to review as a baseline. Let me take a look at this. And they started saying, you know what? It sounds like it's a very service delivery dependent business where you got texts going out and you have to manage them. But at a certain size, you actually automate that entire process of onboarding and recruiting techs. You kind of have an operating playbook. It's really almost like a franchise restaurant, right?
Yeah.
Where you just build a system. It's like we need to deploy capital. This is actually better than we thought. They're high growth rate. The other thing is there's not like if your HVAC unit goes down, you'll shop around to some extent, right? But at the end, you got to fix that. And private equity loves that effectively captive market where like you effectively control pricing, and it's an opportunity where if you can get to a certain size, you can really demand price concessions for your vendors. It has all the
Yeah.
hallmarks of like what does a good deal look like for them. With that, that's how they ended up down market. That's how the multiples got hot. Um, at this point in the cycle, uh, the activity is still there, but it's not like it was during COVID. A lot of things have changed. The biggest one being that interest rates are significantly higher. My thoughts is that you've seen multiple industries who have had these boom and bust cycles with private equity. I don't think that in the long run, just like we're seeing with real estate, entropy is real. Like power does not like to consolidate. Things will eventually break. Things consolidate and then deconsolidate. That's just the
Yeah.
nature of life, right? Having said that, when I'm thinking about the trades now, I don't think we're in the last inning yet. I think we still have room for private equity. What I see now is that prices are down, multiples are coming down. The best assets, the most premium assets, are still demanding very rich multiples, and I think that will stay for some time. If I had to guess, I would say interest rates come down from here
Okay.
for a variety of reasons. I think that reinvigorates some of the buying activity a little bit, but I
Mhm.
do think people are taking a second or third look at this.